have Sandra Torres from California Coast Financial Services. She's a certified financial advisor, and she's going to go ahead and talk to us about these uncharted waters that we are navigating right now. Also, just as a kind of a heads up, I don't know if anyone else has been experiencing this, but it looks like there's been internet issues here in San Diego with Cox Communications off and on, so my internet's a little spotty. So if I drop out, my counterpart, Allison, will take over. So towards the end, if you see her instead of me, that's why. All right. I think, Sandra, you're on AT&T, right? So we shouldn't have any connection issues.
Hopefully not.
Very good. All right. Well, with that, I'll go ahead and turn it over to Sandra, and we can get started.
Okay, great. Well, thank you, Josh. And welcome everybody to our presentation, Uncharted Waters, Navigating Stock Market Volatility in a Coronavirus World. We have a lot to cover, so let's get started. Let's jump in. So what's happening in the markets? With all the events in the news and related market volatility, investors may be wondering, how are these events impacting my investments? Well, this chart shows us the S&P 500 index, the cumulative return for 10 years ending December 31st of 2020. It's amazing if we look at the returns over, it's amazing when we look at the returns over the 1 year period of time, even with the coronavirus and the impact that it had on the market, that the market was actually up in 2020, 18.4%. Over the 10-year time frame, the market was actually up 13.89%. So let's take a look at 2020. Let's take a look at last year with all that volatility that we had. It was pretty interesting. When we looked at last year, we started out with the coronavirus that was first reported in Wuhan, China, in December 31st of 2019. By March of 23, the Dow Jones and the S&P hit a low, and the major economies went into lockdown. The S&P 500 actually dropped 34% from peak to trough. So what that means, from the top of the market to the bottom of the market, it dropped 34% in a very short period of time. June 8th, it was official and declared that we actually went into a recession in February. By November 7th, Biden had defeated Trump, becoming the 46th president of the United States. December 22nd, we had a second round of 2.3 trillion of coronavirus relief bill was passed. By December 31st, nearly 5 million Americans were unemployed compared to February of 2020. So a lot happened, a lot of volatility. It's amazing that we ended up positive and ended up 18% for the year. So what's on the agenda today? Today we're going to cover stock market shocks in a historical perspective. We're also going to discuss what's going on in our heads and living with market volatility. Market shocks in a historical perspective. While most investors know that the market does go up and down and it goes in cycles, but it's times like these, uncertain times, that the markets are very volatile and emotions can run very high. It's important to look at it at a historical view because it also gives us perspective on what has happened in the past. And while the past is not predictive of future, it does offer us a valuable perspective. So let's take a look at bull and bear markets. We're looking at the S&P 500 index over a 50-year period of time. And those of you, if you're not familiar with the S&P 500 index, the S&P 500 index is the largest 500 companies in America. And what we do is we chart the performance on those 500 companies of America. If we look at a 50-year perspective, this is what the market looks like. Even with all the bull and the bear markets over this 50-year time frame, you can see that the upward trend is still up. Well, let's dive a little bit deeper into this. If you're looking at the blue charts here, what that is showing is the bear markets that we've had over the past 50 years. So we have had 5 bear markets over the past 50 years. And what is a bear market? A bear market is a drop of 20% from peak to trough, meaning from the top to the bottom. So if we look in the first bar, which is down 43%, that was the oil crisis. That was when everybody was in line for gasoline, and we were down 43% during that period of time. In 1987, we had Black Monday, October 19th, actually, on 1987 was Black Monday, where we had a 20% drop in one day, but over that bear market period of time, the market was down 30%. We fast forward to 2002, we had the tech bubble. The market was down during that bear period of time, 47%. We moved to the financial crisis, and we were down 55%. The latest bear market we had, because the market was down more than 20%, of course, was the COVID-19, or last year, the pandemic, which we were down 34%. And that was interesting because the S&P 500 actually made history, but not history in a good way. They made history because it was the fastest ever bear market. So the market dropped 34% in 33 days, so a little over a month. Bear markets don't last forever. So let's take a look at bull markets. If we look at the bull markets, we can see that we're up 53%, 845, 818, 121, 529. So all this is telling us is that bear markets don't last forever, and after a bear market, we have a bull market. Let's look at this next slide. Market shocks in historical perspective. We look at the agenda, market shocks in historical perspective. Let's take a look at this. We've seen the bull markets, we've seen the bear markets. This next slide shows us that bull markets last longer than bear markets. The average bull market rose 403%, which lasted 7 years, 4 months. Bull markets, of course, is a up market. Bear market, the average fall or the loss was 42%, and it lasted 13 months. That just gives you another perspective and another graph of the view of the bull and bear markets over that period of time. What this teaches us is that market declines are part of investing. So bull markets and bear markets usually go together when we're investing. If we look at the S&P 500 index over the last 50 years, from 1970 to December 31st of 2020, let's look at the different declines that we've had over that 50-year period of time. 5% declines in the market happens every 10 months. So essentially, you're going to see in every given year that there's going to be a 5% decline that happens sometime during the year. The last occurrence that this happened was August of 2019. A decline or a loss of 10% in the market happens every 2 years, and the last time we had this occurrence was December 2018. A drop or a loss of 15% in the market happens every 4 years, and the last time that happened was in December 2018. Remember the bull market? Bear market? Bear markets mean that we have a drop or we're down 20%. So a bear market happens every 8 years, and the last time we had that was last year during the pandemic, which was March of 2020. So what's going on in our heads? At the end of the day, we're all emotional beings when volatility strikes. And many of us feel like we're probably riding a roller coaster, and it's a roller coaster of emotions. So what's going on in our heads and why? So this is us. This is our brain. Our brains help us to make decisions. Usually, we do quite well. We decide on what are we going to eat, what clothes are we going to wear, what kind of toothpaste are we going to buy, and the quickest route to work. But then we have this little part in our brain that acts on emotions. And this is where it gets a little dicey. Fight or flight. Remember the caveman. When confronted by a saber-toothed tiger, based on past experiences, the brain would tell the caveman that now might not be a good time to run. In fact, our brains associate fight or flight responses. Fight or flight. Well, letting our brain control our reactions when making financial decisions may lead to some desirable outcomes, especially if we're allowing our emotional side of the brain to override our logical side. So remember, investing 101. You do not want to buy high and sell low because it's just not a good strategy. So how do we deal with the volatility? Well, we have one concept called anchoring. We often focus too heavily on one piece of information when making decisions. How does that work? Anchoring influence performance expectations. Well, Franklin Templeton did a survey. They conducted a survey and they asked people their expectations for investment performance over a 5-year time frame. And the investors responded with, I think over a 5-year time frame, that I think it's realistic to earn 10%. And that's good and fine. But what happened? The next year, instead of just earning 10%, the investors actually earned 20%. So guess what the investors did? They adjusted their expectations, feeling that since they thought that 10% over a 5-year time frame was within their expectations, now they're thinking because of that 1 year, they adjusted it upwards. So now they felt that they should be receiving 20% every year. Well, if we look at the full picture and how the stock market works, it tells us a different story. If we looked at the S&P 500 and we looked at a 8% average return based on $10,000 and a 30-year time frame. Based on that 8% return, then investors would have received $100,000. And you could see it goes up in a consistent line. But that's not the way that the market works. If you look at the green line, what that means is that's actually the performance of the S&P 500 over this 30-year time frame. So if you would have invested $10,000, then you would have ended up with $211,000. That's an average return of 10% per year. So what anchoring means is that, as you can see the anchor in the graph, what that means is that when the market goes high and is at a high, investors feel that it should continue to go up and don't correct. They don't want to see any bear markets. They want it to continue to go up in a straight line like the blue line, but that's not the way that the market performs. So you have to be careful about being disappointed when the market goes down, and you need to look at it over a longer period of time. Because as we've seen, we have bull markets where the anchor is at, and then we also have bear markets where the market goes down and adjusts on a decline. So what's the moral of this story? So what we want to do is, when the market drops, you don't want to feel like you lost or you lose sight of your goals because of the short-term drop. You want to focus in on what's your long-term strategy and not let that anchoring derail your longer-term goals or strategy. Loss aversion. The pain we associate with the loss is much more intense than the reward felt from the gain. So what that just means is that we love to win. We love to make gains, and we expect to make gains in the market. But losses are more painful. We hate losing money. That's loss aversion. Let's take a look at loss aversion. Fear drives investors to cash. During the dot-com bust from March 2000 to October 2000, we had the drop in the market. So investors pulled $491 billion out of the market, and they went to cash because they wanted a safe haven. They didn't want to lose any more monies. We also saw during the global financial crisis that investors did the same thing. But we had more money coming out of the market, $943 billion that came out of the market, and investors put it to cash because they didn't want to lose any more money. They wanted a safe haven. Well, let's see what that perceived safety looks like. Let's see what that safe haven might have cost you. If we look at the money market accounts on average from January of 2000 to November 30 of 2020. The blue line is those investors that pulled their money out of the market, and let's say they invested in the money market fund. The money market fund earned 0.07. That's 0.07%. So to give you an example, if you invested $10,000 at 0.7, then you made $7 in interest a year. But if we look at inflation, yay, you made $7. But if you look at inflation, which is that green line, then after inflation of 1.3%, you actually lost $113 a year. And the larger amount is even worse. So if we take the same example, but we have $100,000 that we went to the safe haven and we invested in the money market fund at 0.07, then that means based on 100,000, you're making $70 in interest a year. But then because of inflation, you're actually losing $1,130 a year. So what is inflation? What inflation means that is if you look at $10,000 today, what was the value of $10,000 maybe 10 or 20 years ago? 10 or 20 years ago, $10,000 was worth much more because you could purchase more goods at that time. Whereas now, because of inflation, it eats at your purchasing power or your ability to purchase goods or services. If you look at housing right now it seems pretty high, but if you look at what housing was in the past, it seems pretty cheap if you looked at like 10 or 15 years ago, just because of the price of housing has increased. So what perceived as being a safe haven where people pulled money out of the market and put it into a safe type of investment like a money market fund, sometimes you also have to take into account the effects of inflation and how that eats into a safe type of investment. So how do you live with market volatility with everything going on? Well, we have 3 strategies to help investors live with market volatility. The first strategy is to stay calm. First and foremost, the important concept of investing is to stay calm and keep a long-term perspective. Because whenever you invest in the stock market, it is a long-term type of investment. You never want to put short-term monies you need in a short period of time in a long-term type of investment. First concept, stay calm. Keep a long-term perspective, just like what we said. Here's a chart of the S&P 500 and the cumulative growth of $10,000. Looking at the start of it, if you would have invested on December 31st, 1970, and then at the end of December 31st of 2020, you can see that the blue line, the chart goes up and you're actually making money. But it is a bit of a roller coaster ride. But it's important to keep perspective of long-term goals and looking at over a period of time. And why is that important? It's because of all these blue bars that you see on this chart. It shows all the bear markets that we've had, which range from the energy crisis, Black Monday, tech bubble, financial crisis, and COVID. So a lot of volatility that occurs, and we've had quite a few bear markets. But if you look at it over the longer term, it helps to stay invested and look at it over a longer period of time, because generally you will be rewarded. So if we look at investing $10,000 over this period of time, at the end of this 50-year time frame, your $10,000 would have grown to over $1.7 million. That's an average return of 10.89%, even with all the volatility and the bear markets and the events that happened during this time frame. As we mentioned before, try to stay calm, tune out the noise. And how do we do that? Well, let's take a closer look at this. Here's the S&P 500 from December of 1970 to December of 2020. Percent of time seen. What does that mean? Percent of time seen, what that means is how often are you looking at your investments or your portfolio? A way for investors to stay calm is not to act on emotions, but it's to tune out the noise. Simply said, investors who watch their portfolio on a daily basis, about half the time, or 54% of the time, you're going to see gains or a positive. But then the other part of the time, which is 46%, which is about half the time, you're going to see losses. So it's natural, the stock market does rise and fall on a daily basis. So there's many times that it's going up and down, even throughout the day. And this may cause anxiety for some people to watch their portfolio moving up and down, gaining and losing. But if you can see in this chart, the less you look at your portfolio, let's say if we look at the 1 year period of time, the gains are positive 80% of the time if you wait 1 year and look at it on a 1 year time frame, and the losses are only 20%. The longer you are invested, the more opportunity and chances that you're going to have a gain. For example, for the 5 year and 10 year time frame, then you should have gains 90% of the time, and then the losses would be only about 10% of the time. You still want to, review your portfolio. You want to make sure that if there's any changes in your life goals, or if you need any distributions, you still want to review your portfolio for your goals, objectives, any withdrawals that you might need to take, and you want to look at your time frame and your tolerance for risk. So you still want to do that. You still want to review that with your financial advisor. But the moral of the story here is that if you look at your portfolio too often, daily or numerous times during the day, then you may be causing yourself anxiety, because you're going to see half the time it's going to be up, and then the other half of the time it's going to be down. So that's one way to tune out the noise and live with some of that volatility. Another way to help with the volatility and to help with the returns is diversification. Diversification matters. Diversification helps because it may reduce the overall volatility and provide a smoother ride to bumpy markets. So let's see how that works. In this slide, it shows diversification matters, why diversify, and it's because winners rotate. This is a chart that shows on an annual basis the asset classes from 2005 to 2019, and it shows the best performing asset class, which is at the top, and then the worst performing asset class, which is on the bottom row. For example, in 2005, EM, which means emerging market stocks, had the best performance of all the asset classes. It was up 34%. In the same year, the worst performing asset class was global bonds, which was down 6.88%. So if you were an investor and you had been lucky enough to invest in emerging market stocks and been in that sector in 2005, 2006, and 2007, you would be pretty happy with yourself, and your portfolio would have went up on average over 30% per year. However, if you were an investor where you looked at, I wonder where I should invest my money. So you looked at what was the best performing sectors in the previous 3 years, and you decided, oh, you know what? I want some of that emerging market stock with that 30% return per year. I think I'll put my money in there. If you did that, then you wouldn't be very happy at the end of the year, because at the end of that year in 2008, you would have lost 53% of your money. So this chart shows us that one asset class isn't always the number one performing. Sometimes the asset class that's number one performing is also in the bottom, but there isn't one asset class that is all the time in the top sector, or one that's all the time in the bottom sector. So the need for diversification is important. So let's look at why it makes sense to diversify. If we look at $10,000 invested between 2000 and 2019, there's 3 strategies. One, you're chasing the winners, just like what we did with emerging market stock. You're investing in last year's best performing class. The other strategy is you're investing in the losers. So the ones that did the worst is who you're investing in for the next year. And then we have the last category, asset allocation. So this chart shows that if we were to invest $200,000 into chasing the winners, the first strategy, you made some good money. You're up $438,000. That's a return of 6.99%. Even investing in the losers, you still made some good money. You made over $416,000 and you made 6.56%. But the overall best strategy was the asset allocation, which means you're investing over a variety of different asset classes and not just one. And by doing that, your return was up 469%, which is higher than chasing the winners or investing in the losers, and you're up 7.57% on average. So diversifying makes sense. Remember your strategy. While it may be tempting to pull your money out of the stock market when there's quite a bit of volatility, when the market drops, but it's important to stick with your investment strategy and your longer term goals. Don't let your emotions make you do the wrong thing at the wrong period of time. Stay invested. Here's a chart that I think is very interesting. It's the S&P 500. It's showing the maximum drawdown, which means the maximum loss and the calendar year-end gains in a particular year over a 20-year time frame. So for example, if we looked at 2003, which is the third bar chart over, the blue color means that in 2003, sometime during that year, the maximum drawdown, which means the maximum loss in 2003 was 14%. But the green shows us that the annual return, so at the end of the year though, the investor made 29%. But you can see by looking at this graph that in a given year, there are losses and that's the volatility. There have been losses throughout the year, but then if you look at the green, how many times there was positive performance at the end of the year. If we look at 2020 as an example, we had the drop because of the pandemic. So our maximum drawdown, which was the maximum loss, was 34%. But then we ended the year up 18%. This is a great graph just to show you throughout every year, there's going to be times where you're going to be at a loss and then also times where you're going to have some gains. So it's important to stay invested. One strategy that has worked well is called dollar cost averaging. So what is dollar cost averaging? Dollar cost averaging is a way of investing a set dollar amount over a period of time. So as we can see in this graph, we're investing $500 every month. If we look at the first month, which is January, we're investing $500 and our share price is $9. The amount of shares we purchased was $55.06. In February, the price of the shares, which means because of the price is higher, that means that the market was up. Yay, the market went higher. But for those $500 we're investing, we're only able to buy 50 shares. So what this is showing is that when the market goes on sale and you're investing a set amount of dollars, you're going to be buying more shares on sale at a cheap price. Whereas when the market goes higher, like we see in May, you're investing $500 and it's costing you $12.25. So that means you're only able to buy 40 shares. So in all, dollar cost averaging, what that does is it allows you to accumulate shares, more shares when the price is on sale or cheaper, and less shares when the market is high and the price is higher. So if we looked at an average share price of $10 for our investment, our average cost then was $9.77 because we're able to buy more shares cheap and less shares that when they were higher. So overall, our investing cost is, we saved about 23 cents less per share over that period of time, which just means we're able to accumulate more shares over that set time frame because we're buying cheaper shares and we're buying more cheaper shares. So dollar cost averaging is a great way to invest. Remember your strategy. What about if you jumped in and out of the market? Let's say you had that crystal ball and you thought that you could time it perfectly. Let's see what that might look like. So this study is based on the S&P 500 index over a 20-year time frame. If you stayed fully invested and you didn't make any jumps in or out of the market over that 20-year time frame, you would have made 7.5% per year. What if you missed the 10 best days over that 20-year time frame? Then your return would have been only 4.5%. What if you missed the best 20 days over that 20-year time frame? You would have only made 1.86%. What if you missed the best 30 days? Now that's only 30 days over a 20-year time frame. You would actually be at an average annualized loss of 1.5% per year every year over the past 20 years. That's a big difference. This is a great chart of showing that you should stay fully invested because it's easy to miss the best 10 days or 20 days or 30 days over that 20-year time frame. Let's take a deeper dive into that concept. This graph shows don't time the market. This is the S&P 500 over that 20-year time frame. And we have the chart on the left showing the 20 worst trading days. And then on the right, the 20 best trading days. Let's take a look at this. So the worst trading 20 days, the first one was March 16th of 20, and the market was down 12%. Well, guess what was the best 20 trading days? The next day, March 17th, was the best trading day, and the market was up 9.3. So if you would have sold out when the market was down 12%, you would have missed that best trading day, which was the next day. Let's look at however many times that this happens. As you can see, it happens pretty frequently that after the worst trading day is usually the best trading days. Very hard to time the market. The key takeaways. History has shown us that while markets react to shocks in the short term, they tend to be rewarding investors if they stay with it over a longer period of time and not try to time the market. Emotions affect decision-making ability in times of market volatility. Don't let your emotions derail your longer-term goals. 3 strategies that can help to live with market volatility are to stay calm. Remember, don't look at your portfolio on a day-to-day basis. Diversification matters because the leaders of the asset classes do change. Sometimes they're number one, sometimes they're the bottom. And then remember your strategy. Remember your goals, what your goals are, what your objectives, your risk tolerance, and the time horizon. So what will 2021 hold for the markets? Well, we know that there's two things we know for certain. It's number one, difficult to predict the markets, and market volatility is just part of investing, which means we're going to continue to have bull markets, up markets, and we're going to continue to have bear markets, down markets. That's just part of investing. But the good news is that you don't have to go it alone. My advice is to seek the help of a financial professional. Your financial professional can make a difference because coaching and helping your personal trainer can also make a difference. So there's a personal trainer not only for your health, but there's a personal trainer that can help you with your investments and finances. They'll help to build a long-term strategy, keep your emotions in check, and then help you to stay on track with your goals and objectives. And who is that coach? Well, that coach is your financial professional. We can help you build your long-term strategy, keep your emotions in check, and then also stay on track. So I encourage all of you to seek the help of a financial professional. And even if you have just questions or you just want a second opinion or a second look on your investments, you don't have to go it alone. You can always have a financial professional help you. And with that, that concludes our presentation. So now, if we have any questions, I'm happy to answer them.
All right, well, thank you so much, Sandra. A lot of great information. I know it's probably a lot to process, so we'll give everyone a couple minutes here to formulate any questions that they might have. But in the meantime, I did want to mention that in the chat box, I've placed the link that you can visit so that you can schedule an appointment with Sandra and our financial services team if you'd like. Oh, and there's her information right there. So if you would like to talk with someone, you can do that anytime. The initial consultation is free, and it's just a part of the services that we offer, especially for our partners, such as the City of San Diego and employees of the city. So please take advantage of that. We also have some great resources that are on our City of San Diego employee landing page. We have recordings of previous webinars that you can watch at any time. We have our Enrich Financial Wellness platform, which has all kinds of tools and videos and articles and courses you can take on any number of financially related topics, including retirement. And that's all, again, free to you to use. So I'm going to go ahead and place the link to that page in the chat so you can visit and take advantage of those. We also have something new. It's called our Financial Wellness Center. And it's actually a center that we have staffed virtually 2 days a week for a couple hours a day. It's on Tuesdays and Thursdays from 11 to 2 p.m. You can actually go in and speak to one of our financial representatives anytime to have any questions that you have answered about your personal finances, or if you have any general questions, if you're looking to increase your credit score, get out of debt, create a budget, anything like that, we can help you out. We're here to serve you, and we are now available live through Zoom 2 days a week for a few hours a day. So again, that's all on the landing page, which I'll put into the chat. And so bookmark that page. It's a really great resource in case you ever need anything at all. All right, Sandra, I got a few questions for you. Oh, real quick, will the slides be available? We actually will have a recording that will be going out to you, a link to the recording of this session that you can view at any time. And we also will post this recording on the YouTube page that has all the other recordings of the other webinars we've done. So you can go back and take a look at any time. All right, so Sandra, what is a typical fee for a financial advisor?
That depends, and it depends on the product, and it depends on the service. So what I would say is it's best to make an appointment or have a chat with a financial advisor, so that way we can understand how best to help you, and we can we'll always let you know what that cost will be, so that you do have all the information on that product or service that we're looking at. So it varies.
In short.
I always think of, if you go into a supermarket and you ask what's the price of what's here in the supermarket. Well, it depends. So it depends. Do you like, steak, or do you like vegetables? So it varies, but it depends on what's the product or service that you're looking for and that's best for you.
All right. What about this question here? Should a separate bank account be created to link to investing?
A separate bank account. You could have a separate bank account if you wanted just to keep track of maybe additions, if you're adding or taking monies out. I guess you could do that, but there isn't a requirement to have a separate bank account for investing. You can have a separate investment account. If you wanted to invest, you would have a separate investment account, but there isn't a particular need, unless the investor preferred one, to have a certain bank account linked to their investment account. Hopefully that answers your question.
All right, and this is a tricky question. Is this the best time to buy stocks currently in the market? Hard to say, right?
It's hard to say.
Yeah.
But it's tough to say until you look, past in history. Just like, for example, when the market was down 34% because of the coronavirus, was that a great time to buy? It was a great time when we looked past in history. But if you look at any point in time in history, there usually is something that is on sale, is what we would say. Like, for example, there may be times where, for example, like technology stocks may be, high or overpriced, and maybe like during the coronavirus and the pandemic, it was the technology stocks that went very high. And then what went down? Well, banks went down, the airline stocks went down, oil went down. So there's usually times in the market where there might be some opportunities in one type of investment or one sector, or maybe bonds might be better than stocks. So there usually is always something that may be attractive than, some other type of investment. But I think the point is that it's important, if you're saving for retirement or saving for the future, that you sit down with a financial advisor and do some sort of investing that could potentially help you to reach your goals.
Yes, and I think it's good to keep in mind too that throughout history, the market has always just gradually gone up, right? So over time, there's a very, very high chance, it's very likely that the market's going to go up either way, right? It might dip up and down, but it's going to go up overall.
Mm-hmm.
So that can help you make your decisions as well.
Yeah, and as long as you feel that with the stock market, the investments that you're investing in, their prospects are good in the future, that they're going to continue to be profitable, then that can help you thinking long term, just like what Josh had mentioned.
Awesome. I have a question about investments or investing for kids. If you want to get a 12-year-old started on investing in stocks, is it possible for them to have their own account, or do they have to have that under a parent, and they can only do it when they're 18, or how does that work?
Yes, so they cannot have an account because you have to be of legal age to be able to have an account, but a parent can open up what's called either a 529 college plan, and that's if the monies are earmarked for saving for college, or they can have what's called a unified gift to minors, UGMA, or what's called UTMA. So it's a minor's account, but there still is a custodian or a parent on the account for the minor. And depending on the state, the legal age, it's usually either 18 or 21, then the minor has control of the account. So a minor can't have the account in their individual name by themselves, but with a parent, they could have a minor's account.
All right, well, great. Let's see, I'm waiting to see if any other questions come in, but in the meantime, I did go ahead and put the link into the chat box that will direct you to the landing page we have set up just for you as a City of San Diego employee. Again, a lot of great stuff there. Visit that, take advantage of it anytime you need. We want you to be financially well as well as physically well. So, it's very important that we get you the tools and the info and the resources that you need. We're here for you anytime. And please feel free to reach out to us if you ever need anything at all. Doesn't look like we're getting any more questions. So I think, oh, one just popped in, sorry. Let's see. Would help setting up the unified gift be part of a service by a financial advisor? Does that make sense to you?
Yes.
Sandra?
So we can help to set up a like a unified gift to minors account or unified trust account for minors. So we can help to set that up. Yes.
Okay, awesome. And what is the difference between a fiduciary advisor and a financial advisor?
So fiduciary advisor means that we have to have your best interest in mind and that we're held at a high standard, which with the recent laws that went into effect, we are fiduciaries now. Financial advisors are held at a higher standard now and considered fiduciaries.
I learn something every time. All right, and also another good question, are there any tax implications if you designate your adult children as beneficiaries on your investment accounts?
Any tax questions? I would refer that because we don't give tax advice and we're not tax accountants. I would ask your tax advisor that question or tax accountant.
All right. Let's see. Do I need an account with CalCoast to use your products or to get an appointment with a financial advisor?
No. We can work with you even if you aren't a California Coast member, but we would encourage you to be a California Coast member just because of all the benefits and services that they offer.
All right, and this one might be tough to answer as well, but do you think the market for house prices would go up or down soon? I don't know if that one's, it's tough to call.
Yeah, that's, I think, more of a real estate agent
Yeah.
that would probably have more of a, I think, a better opinion and insight on that.
Yeah, there are other resources that you can access again through our website that we've set up for you that would help to answer that question and any tax questions that you have as well. But you can always reach out to us and we'll connect you with the right person to get those answers for sure. All right, here, one more question here. How much control does an investor have in the decision-making process of investing versus an institution advisor?
So it depends on the account and the level of service. Some investors want to have more control and decision making over their investments, so we have a particular account for that. And then other investors just want to have us define what their goals, objectives are, and then they want somebody else to manage it on a day-to-day basis. So there's two different types of accounts and services for those two different types of investors, and how much control they want to keep versus how much do they want to hand over and maybe let somebody else manage it for them.
All right. Well, we're heading right towards 1 o'clock, so I think we'll go ahead and start to wrap up. I just want to thank Sandra for presenting today. A lot of great information. And again, you can contact Sandra anytime and talk to her and get more info and talk about investing. We also have, in case you are not a member of CalCoast yet, we have a special for City of San Diego employees that actually ends at the end of this month. So if you are thinking about becoming a member, take advantage. It's if you sign up with checking and savings with us with e-statements, then you get $100. We actually pay you $100 to join us. So again, if you're interested, you can contact us. You can also utilize the link on the website to apply. And with that, I think we'll go ahead and wrap up. Really appreciate everyone joining us today. Stay healthy, be safe out there, and keep an eye out for our next session coming up in April. And we will see you then.